Let me be direct. While American policymakers have been congratulating themselves on the supposed permanence of dollar hegemony, China has been executing one of the most consequential wealth transfers in modern economic history. And the remarkable thing is not that it is happening. The remarkable thing is that it is happening in plain sight while Western institutions actively choose not to see it. This is not about conspiracy. This is about willful institutional blindness, dressed up as sophistication. And that blindness is going to cost the United States dearly. China has been accumulating physical gold at industrial scale for over 20 years, not as a side project, not as portfolio decoration, as deliberate state policy executed with the kind of long-term consistency that American institutions can no longer muster. The People's Bank of China has been buying gold month after month, year after year, regardless of price, regardless of market sentiment, regardless of what Western economists declare to be rational. And every single time Western analysts are asked about this, they offer the same condescending dismissal. China does not understand modern finance. China is being irrational. China is clinging to barbarous relics. This dismissal is not analysis. It is intellectual arrogance masking strategic incompetence. Because while Western economists have been writing papers about how gold is irrelevant, China has been building the foundation for a post-dollar world. Let me be explicit about what is actually happening. China is not accumulating gold because it believes in some romantic return to the gold standard. That is a straw man used by people who do not want to confront the real strategy. China is accumulating gold because it understands something that American policymakers refuse to acknowledge. Financial systems are weapons. The dollar is a weapon. Sanctions are weapons. And access to dollar clearing systems, to SWIFT, to Western financial infrastructure, can be severed whenever Washington decides its geopolitical interests require it. Gold cannot be frozen. Gold cannot be sanctioned. Gold cannot be seized with a Treasury Department memo. Gold exists physically, moves physically, and operates outside the architecture of Western financial control. This is not about nostalgia. This is about building a financial system that cannot be strangled by American policy decisions. And the fact that Western institutions treat this as irrational reveals how deeply they misunderstand the game being played. Now look at the United States. The United States sits on over 8,000 tons of gold, the largest official reserve on Earth, and treats it like a museum piece. There is no strategy, there is no accumulation, there is no serious policy discussion about gold's role in a fracturing monetary system. Why? Because American institutions are trapped in the mythology of their own dominance. They cannot imagine a world where dollar supremacy erodes because they have spent 70 years inside a system where dollar supremacy was the one constant. This is not confidence. This is intellectual calcification, and it is dangerous. The structure of American decision-making makes strategic gold policy impossible. The Federal Reserve answers to inflation targets and employment numbers, not geopolitical positioning. The Treasury Department rotates leadership every few years, each team arriving with fresh ideology and zero institutional memory. Congress responds to donors and voters, not multi-decade structural shifts. And Wall Street, which dominates the entire discourse around monetary policy, views gold as a non-productive asset that competes with the equities and bonds they profit from. No one in this system has the authority, the incentive, or the time horizon to execute what China is executing. And so the American response to China's gold strategy has been to pretend it does not exist, to mock it as primitive, to reassure themselves that markets are efficient and therefore Chinese behavior must be wrong. This is not strategy, this is delusion. Here is what the data actually shows. China's official gold reserves have grown from roughly 1,000 tons in the early 2000s to over 2,000 tons today. But anyone who takes these numbers at face value is not paying attention. China's state-owned enterprises, sovereign investment vehicles, and deliberately opaque reserve structures allow for accumulation that never appears in People's Bank of China headlines. Serious analysts believe China's real sovereign gold position is far higher, possibly double the official figure, possibly more. We do not have perfect transparency because opacity is part of the strategy, but we do know this. China produces more gold than any other country on Earth, roughly 400 tons annually, and not 1 ounce of that production leaves Chinese borders. Add consistent imports through Hong Kong and Shanghai. Add purchases routed through intermediaries. Add 2 decades of patient, relentless buying, and you are looking at accumulation on a scale that rewrites the global gold market. This is not portfolio management. This is state-directed economic warfare, And yet Western media treats this like a footnote, a quirky cultural preference. There is barely concealed contempt in the coverage, as if China is doing something embarrassingly backward while the sophisticated West has moved beyond such primitive concerns. This contempt is not journalism, it is projection, because what China is doing is not primitive, it is sophisticated as hell. China understands that financial dominance is not a law of nature. It is a structural position maintained by network effects, institutional inertia, and geopolitical alignment. And all of those things can shift. Are shifting. The petrodollar is weakening. Bilateral trade in yuan is expanding. Central banks globally are diversifying away from dollar assets. Sanctions have accelerated the creation of parallel payment systems. None of this requires the dollar to collapse tomorrow. It just requires the slow, grinding erosion of monopoly. And in that world, the nation with the largest reserves of physical, non-seizable assets has options no one else has. China is not reacting to this shift. China is engineering it. Every ton of gold purchased is not about financial return. It is about optionality, about creating the capacity to anchor a new monetary system when the old one fragments, about being able to collateralize non-dollar liquidity, about signaling to other nations that there is a credible alternative to dollar dependence. This is grand strategy executed at the level of reserve accumulation. And the reason it looks irrational to Western economists is that Western economics does not have a framework for thinking on this timescale. Discounted cash flow models do not capture the value of sovereignty. Mean variance optimization does not price the cost of sanctions risk. Modern portfolio theory does not account for what happens when the global financial architecture splinters. So Western analysts look at Chinese gold purchases and see waste. What they should see is preparation. The American failure to respond is not an accident. It is the predictable output of a system designed to defend the status quo, not adapt to its erosion. Every major constituency in American economic policy benefits from the current structure. Wall Street profits from dollar dominance because it generates fees, spreads, and structural advantages in every transaction that touches the global financial system. The defense establishment benefits because financial sanctions allow coercion without military risk. Politicians benefit because foreign demand for dollar assets allows deficit spending without immediate fiscal consequences. None of these groups has an incentive to acknowledge that the foundation is cracking. To do so would require admitting that American power is not permanent, that it is contingent, that it is eroding, and that conversation is politically lethal. So instead we get reassurance, we get mythology, we get the insistence that China is being foolish while America remains wise. This is not leadership. This is managed decline with better marketing. There is also a cultural dimension that cannot be ignored. American economic thinking is shaped by assumptions about efficiency, liquidity, and short-term rationality that make long-term strategic patience invisible. If gold accumulation were smart, the logic goes, markets would have priced it in already. Investors would have front-run China. Gold prices would have spiked years ago. But this reasoning assumes that markets are the ultimate arbiter of strategic value. They are not. Markets are good at pricing near-term cash flows. They are terrible at pricing shifts in the global order that unfold over decades. China is not trying to beat the market. China is trying to outlast the system. And that kind of thinking does not fit into any model taught at Wharton or Harvard Business School. So it gets dismissed as irrational. And that dismissal is costing America the future. Let me tell you what happens next if these trends continue. China keeps buying, ton after ton, year after year. Other central banks, watching the erosion of dollar monopoly and the expansion of sanctions risk, begin their own accumulation. Gold becomes a larger share of reserves across the developing world. The dollar does not collapse, but its share of global reserves declines. Slowly, persistently. And in that environment, nations with deep gold reserves have leverage that others do not. They can backstop regional currencies. They can collateralize liquidity in non-dollar systems. They can launch digital currencies with credible asset backing. They can signal stability and sovereignty in ways that nations dependent on dollar access cannot. Gold does not need to become the global currency to be strategically decisive. It just needs to enable alternatives. And alternatives destroy monopolies. Gold prices will reflect this reality, not smoothly, not predictably, but structurally. Central bank demand is not speculative. It is strategic. It is consistent. It is growing. And it is being driven by nations that are not buying to sell next quarter. They are buying to hold for 50 years. As that demand compounds, as supply remains constrained, as more investors and institutions wake up to the fact that the global monetary system is fragmenting, gold will rise, and the nations that positioned early will have accumulated at prices that look cheap in hindsight. China understands this. America is still pretending it is not happening. Here is the brutal reality. The United States had every advantage: the largest gold reserves, the most sophisticated financial markets, the deepest capital pools, the dominant reserve currency, and it squandered those advantages by assuming dominance was permanent, by dismissing competitors as irrational, by allowing short-term incentives to override long-term strategy, by letting lobbying interests shape monetary policy, by prioritizing narrative over reality. And now, after 2 decades of Chinese accumulation, after clear evidence of strategic intent, after observable shifts in the global financial system, American policymakers are still not responding. They are still mocking, still dismissing, still reassuring themselves that markets are efficient and therefore Chinese behavior must be wrong. This is not wisdom. This is institutional failure. What China has done is not complicated. It identified a strategic vulnerability in the dollar system. It recognized that financial dominance is contingent on network effects and geopolitical alignment. It understood that those conditions were eroding, and it acted, methodically, patiently, without needing permission from voters or shareholders or quarterly earnings calls. It executed a multi-decade strategy while American institutions were optimizing for the next election cycle. And the result is that China has built optionality that the United States does not have. Not because China is smarter, but because China's system allows for the kind of long-term planning that American institutions can no longer sustain. This is not a story about the inevitable rise of China or the inevitable decline of America. This is a story about institutional design and strategic competence, about what happens when one system can plan in decades and another can only react in quarters, about what happens when one side treats economic competition as existential and the other treats it as a portfolio problem, about what happens when dismissiveness substitutes for analysis. The shift is already underway, the gold has already been accumulated, the infrastructure for non-dollar systems is already being built, and the American response has been to pretend none of it matters because acknowledging it would require acknowledging that the world has changed. The question now is not whether the dollar will remain important. It will. The question is whether dollar monopoly will persist. And the answer, based on observable trends and structural incentives, is no. The monopoly is eroding, margin by margin, system by system, and the nations that prepared for that erosion will have advantages that those who assumed permanence will not. China is not guessing about the future. China is building it, ton by ton, year by year, while America watches and calls it irrational. History will not be kind to that choice.